There's one ETF that people are consistently forgetting about, and if you could keep this on your radar, the next couple years are going to be very nice for you. I've doubled down on this one ETF, and I want to explain not only why I'm going all in on it, but also the significant data that we have from the past that shows that when the Fed has lowered those rates, this has happened. Now overall, I believe that this is the time to be buying stocks and ETFs heavy, because history has shown that news of lower interest rates tends to energize equity investors, which pushes stock prices higher. We're about to experience a huge shift in the stock market, and today's CPI data confirms that big time, especially for this one ETF.
And the new CPI report shows U.S. inflation cooled in May, raising hopes that price pressures are easing. The May Consumer Price Index had no change from the month before, while overall inflation was 3.3% compared to the same time last year. The report comes just hours before the Federal Reserve is set to make a pivotal decision on interest rates. ABC's Elizabeth Schelsey joins me now for more. Elizabeth, sometimes these economic reports can get a little bit boring, but this one can have a direct impact on our credit card rates, on home loans, car purchases, you name it.
Seeing that things are generally getting better and that we're trending toward what we have been trying to trend toward, things are about to change in the stock market.
Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher, 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same.
Since we are trending down in that pattern of bringing down inflation year over year, and likely we'll have some rate cuts by the end of the year and then deep into 2025 and 2026, there's going to be one ETF that's going to benefit big from all of this news. When the Fed does decide to cut rates, high yield savings accounts and bonds and money market accounts are going to go down from their rates of 4 to 5% all the way down to like 1, maybe 2%. This is not going to be as attractive as an option for cash flow investors. The ETF that stands the most opportunity for growth and that will give investors not only solid cash flow but also price appreciation as far as the share price is going to be the one that most people have been writing off lately just because of its lackluster performance. But it's time to bring it back in the mix. This ETF is SCHD, and it's the Schwab US Dividend Equity ETF. It recently reconstituted its holdings, and when it did, I told everyone that this was a good move long term. Before the reconstitution, the ETF was getting about a 3.2 to 3.4% dividend yield. It reconstituted with the goal of producing a 4% dividend sustainably and long term. And in just a couple months, it's already risen to 3.82%. Analysts predict a 6% share price appreciation growth per year for SCHD, and then a 4% dividend, so that would give you a total return of 10% in a fairly safe value-style fund. No one's talking about this huge fact, though. We may have a recession coming which happens even with rates getting cut, and sometimes accelerated because of a rate cut, so let me explain why SCHD is poised, better than any other ETF, to let your portfolio thrive no matter what happens in the economy. First, there's the acceleration of non-Magnificent 7 earnings growth as the earnings recession that ended for tech back in 2022 ends for the rest of the economy. Up until now, companies like Nvidia and Microsoft have been skyrocketing growth ETFs and the S&P 500 by themselves. But as you can see from this data, the rest of the S&P 500 is starting to catch up as big tech slows slightly. Big tech companies cannot continue to grow at the rate that they've been growing. Yes, it's been awesome, and I'm sure a bunch of you have made some good money on it, but you can't expect that growth to keep happening. Everyone's piling into these fun stocks and these crazy growth ETFs because, yeah, this is the place that a lot of people have made a lot of money. But just because it made money in the past doesn't mean it's going to make money in the future, and usually when something's been going up for a while, it starts to stall or even drop a bit. Smart investors don't invest where everyone else is investing, they start investing in where people will eventually start investing. As I said before, money market accounts and high yield savings and even some short-term bonds offer some amazing deals right now. You're getting a guaranteed 4 to 5%. For the last couple of years, most wealthy investors have just decided to put their money there rather than in dividend ETFs because it takes down that risk of the possible price that's going to drop possibly and just keeps their money safe while still giving them that 4 to 5% dividend. So why not? There's currently over $9 trillion in money market funds, accounts, and CDs with the rates as high as they are now. Now, I'm not saying that all $9 trillion of those dollars are going to go from those money market accounts and high yield savings accounts into the stock market and into value ETFs like SCHD or VYM. But what I am saying is that a portion of that is definitely going to be making its way into the best possible option. Here's a couple things that happen when the Fed cuts rates. Short-term rates like savings or checking account yields and T-bills will fall. Bond investors will move money from short-term to long-term bonds to lock in the yield. Falling long-term rates reduce mortgage rates, accelerating parts of the economy like housing. Falling long-term rates cause some money to flow into high-yield stocks that have underperformed as rates rocketed higher. So basically, in your savings account, it's not going to be as advantageous to just hold money. It's going to be much better for you to put it into certain things that are being affected because people are spending more money because it's cheaper to do so. Once the fund rate starts to drop, one of the biggest sectors to be affected is going to be consumer staples. It just so happens that one of the largest sectors in SCHD is consumer staples. Consumer staples are companies like Coca-Cola, Pepsi, Walmart, Home Depot, Costco, and Target. When interest rates are lowered, this can reduce household debt costs and improve spending power, as more people will feel like they have more money to buy more things. One thing, though, that I talked about earlier is that people are definitely fearing a mild recession coming our way. Consumer staples and value ETFs like SCHD are the ones that are going to be the ones that gain in something like this. If the falling interest rates cannot prevent recession, many investors will likely move into consumer staple stocks defensively. People need to keep buying these essential items just to live. So smart investors put money where people are going to be spending money so that it keeps their portfolio as safe as possible and makes it so that they don't lose as much money. When people put more money into the consumer staple sector, that just means that ETFs that have a high amount of this sector are going to do much better. And certain ETFs that have safe, boring companies like SCHD are just going to be the beneficiary. SCHD is the gold standard of high-yield dividend blue chip ETFs. If you understand what SCHD is and what it's designed to do, you can harness some of the best dividend blue chips on earth. Now, SCHD is slated to grow just a little bit slower than it has over the last 10 years, but the numbers are still awesome. Analysts predict a 6% price appreciation growth per year and then a 4% dividend, so that would give you a total return of 10% in a fairly safe value style fund. If you own SCHD, you could live off dividends alone if you grow this thing big enough. And the income growth rate of 6% is 2.5 times more than the bond market expects inflation to be long term. As I said earlier, I'm buying this one up like crazy. One, because it's not overly inflated with tech stocks and things that are a little bit overvalued at this point. So it's just keeping the rest of my portfolio safe because I am still investing in the 3-fund portfolio and I do have growth ETFs in the S&P 500. So I like to have this one as a safety. But also right now, SCHD has been a little bit underperforming. And so since not many people are buying into it, it's at a good value or at a better value than some of those other ones. Here's a video explaining that 3-fund portfolio and why it might be a good idea for you to consider that for your investing. Or watch this video to keep you going strong in your investing journey.